In this video, I'm going to show you how to reduce or even eliminate taxes paid on your Social Security payments. Coming up next on Holy Schmidt.
Holy Schmidt!
For many people in retirement, every dollar counts. And just like your working years, understanding how to manage your tax bill is of paramount importance to a retiree. This video will discuss how to cut your tax bill on two different types of taxes: state income taxes and federal income taxes. Let's start off with state taxes because this one's quite easy. Then we'll move on to federal taxes, and I'm going to show you several different ways to bring your tax bill down or close to zero. We'll end the video on one point that almost everybody misses on federal taxes that's an absolute game changer, but it does require a bit of planning. Before we begin, please make sure you click subscribe and notifications so that you get alerted the next time I post a video. Social Security is moving fast now, and I want to make sure that you get alerted the next time I post a video. Let's start off with state taxes on Social Security. Currently, there are 38 states that don't tax Social Security. Practically speaking, this means that you have a 76% chance of not paying taxes at the state level on your Social Security payment, but you do need to check to make sure that your state is one of the 38. If you don't live in one of the 38 states, you have two choices. You can move to one of the 38 states, and a lot of retirees do this, or you can do what I'm going to show you next for your federal taxes, and you'll have the benefit of the same impact on your state taxes. By the way, I list the 38 tax-friendly states in the description below so that you have the information at your fingertips. You don't need to go anywhere else except for right down there. Let me begin by saying that I'm not going to take this into deep math. I'm going to make it very easy for you. You don't need to understand tax math here, but I will provide a few examples for you. You can either trust me when you look at the examples, or if not, you can go to my website. I'll give you a link down below which shows you how to calculate exactly what I'm going to show you here. But in order for you to understand what I'm going to tell you, there are three terms that you need to know. The first is what I call traditional income. Basically, this is your taxable wage base plus municipal bond interest. This includes things like a 401k distribution, earnings from your job, interest, dividends, etc. All of that is taxable. But traditional income does not include your Social Security payment. The next term is what is called provisional income. I'm just going to call it combined income here because that's a much easier and probably more accurate definition of what we're talking about. Combined income is just your traditional income, wages, 401k distributions, dividends, interest, etc., plus 50% of your Social Security payment. You put those together, and that is your combined income. And that's the definition we're going to use for the rest of the video. By the way, why 50% of your Social Security payment? That's just the number that the government came up with when they designed the formula. The last point are what are called IRS thresholds, or just thresholds. This is the dollar amount of your combined income above which you start to get taxed on your Social Security payment. Currently, if you're single, the threshold starts at $25,000 of combined income, and if you're married, the amount is $32,000 of combined income. Married filers who earn between $32,000 and $44,000 can have up to 50% of their Social Security benefits taxed, and above $44,000, that can be up to 85% of your Social Security benefits. And just for completeness, I'm going to show you one example, and then I'm going to get into how to reduce your traditional income so that you in fact reduce your Social Security tax. Let's say you had traditional income of $50,000 and Social Security payments of $13,200. Your combined income would be $50,000 plus half of $13,200. That's $56,600. Assuming that you're married, the first $32,000 would be excluded from the calculation, and you would be taxed on $11,220 of your Social Security payment. That's $13,200 times 0.85. It's important to note that the way that your taxable Social Security amount is derived depends on your income level. Again, if you go to my website, holyschmidt.com/SS tax, you'll find a spreadsheet there that will help you with this calculation for your individual situation. As I said at the beginning, this video is about reducing or eliminating tax on Social Security, so let's get into that. In order to reduce or eliminate tax on Social Security, you need to know what you can control and what you can't control. The first point is that you can control tax on Social Security by waiting to take Social Security until a later age. The IRS can't tax your Social Security payment if you don't take your Social Security payment. This has the added benefit of providing you with a larger payment in retirement. The Social Security payment for someone who takes Social Security at age 70 is 77% higher than someone who takes Social Security at age 62. The other option, and the one we're going to focus in on for the rest of this video, is reducing traditional income. That means reducing your taxable income and or muni bond interest and transforming it into something else that you can still spend but doesn't fall under the definition of traditional income. The first is through the use of a Roth IRA or Roth 401k as opposed to a traditional IRA or 401k. When you contribute to your 401k or your IRA, what you put in most cases, provides you with a tax break. Conversely, when you take it out, you're taxed on 100% of everything you take out from your 401k or your IRA. With a Roth IRA or 401k, you contribute to the fund with after-tax dollars, but in return, when you withdraw the money from the fund, you take it out tax-free, including growth. This means that the funds from a Roth are not part of traditional income. A Roth is a fantastic planning tool because it allows you to steer your income. Take a little bit more from your Roth 401k or IRA and a little less from your traditional 401k or IRA if you want to achieve less taxable income. Most employers offer a Roth option, and if you're already in retirement, they offer a Roth conversion option. I will note that if you convert from a traditional to a Roth, you will pay taxes at the time of conversion. The second fantastic option is the use of a health savings account, or an HSA. An HSA is a vehicle that allows you to contribute to a savings account to pay your medical expenses. You contribute with pre-tax dollars and you take them out untaxed, so it has a double benefit. Unlike a flexible spending account, or FSA, which is a use it or lose it account, meaning if you don't use it within the year that you contributed, you lose the money in the account, an HSA allows you to contribute and save the balance over your lifetime. An HSA does have some restrictions. An HSA typically requires you to have higher deductibles, but the benefits often outweigh the higher deductible. This is, of course, an individual decision for you and a subject of another video. The third point is what wealthy people do quite often, and that is selling stocks or mutual funds that have not done well so that there are no gains. They let their winners run and they sell their losers. This creates cash flow, but non-taxable cash flow. The seller often even gets a tax deduction for the loss on the stock, which can later offset taxable income and bring down your traditional income. The final point is the use of rental real estate. Rental real estate has wonderful tax benefits because if done right, there's cash flow positive, maybe even extremely cash flow positive, but because you are depreciating the house or the apartment over time, you're actually taking a tax loss, particularly in the beginning and middle years of ownership of the property. So you're paying no taxes, maybe even getting a tax deduction, and at the same time getting a lot of cash flow coming in. If you like this video and you'd like to see more of me, please make sure you click subscribe notifications so that you get alerted the next time I post a video. As I said earlier, I post about twice a week. Also, check out this video on the average net worth of a 62-year-old. This is Jeff Schmidt. Thanks for watching.